There is the Canadian dollar. We have seen it sliding to the lowest since 2020, under pressure yet again, partly because the Bank of Canada pushed through that big interest rate cut earlier this month, a whole 0.5 percentage point. Let's get more from Karl Schamotta, Chief Market Strategist at Corpay. It's great to see you.
You as well.
This weakness in the loonie against the U.S. currency, is it partly just the U.S. dollar is strong?
Yes. If we look at what's really happening in global currency markets, we've seen U.S. yields move up dramatically since September, both on the basis of outperformance in the U.S. economy, as well as people hedging against the inflationary consequences of a second Trump administration. And so the dollar's been powering higher against virtually every major currency, but the Canadian dollar has been outpacing those declines relative to the euro, to the pound, et cetera, mostly on the basis of that, sort of weaker domestic situation and the Bank of Canada making easing noises, as far as giving us guidance as to what it might do in the months ahead.
So our currency has fallen a little more than, say, the euro against the US dollar.
That's right. It is underperforming on a global basis.
Although it's not too bad. I'm looking at it versus the euro. We're at about 66 euro cents. It's been pretty steady.
Very stable, yeah. And what's sort of amazing, too, is if you look at the chart for the dollar-Canada pair, we've repeatedly sort of hit the same level over the last couple of years, right?
Yeah.
In fact, right now, although we are, last night we closed at the weakest level since the pandemic. The last time we touched a similar level was actually in October 2022. So we bounced off that level 5 or 6 times. And, now the question is, what's the catalyst that could really kick us beyond? And that is, of course, what the sort of rumor mill is putting out there on the street right now, is that if we see, a non-farm payrolls report that, dramatically widens the spread against Canada, or we see a really negative result out of next week's election, both of those things could potentially drive the Canadian dollar right back through, the dollar-Canada rate of 140, which in Canadian dollar terms would be about 71.40, somewhere in there.
Yeah.
So 71.40 is a really key psychological barrier. If we get past there, then you're looking at further downside.
When you see the election results that would move the currencies, what do you mean?
I mean, if Trump wins.
Okay.
I could have put that more bluntly, but
sure.
The reality here is that, currency traders are anticipating a big shock to the Canadian economy if we do see Trump emerge victorious, mainly because of tariffs, but partly just that overall uncertainty level that he would bring to, global trade and to business relationships around the world. And so what is happening right now is that traders are sort of hedging in the expectation that this is a possibility. We don't know to what extent this is priced in, given that, we've seen Trump's odds increase in prediction markets in recent weeks. But we do think, that there's still room for further weakness if we do see a clear and decisive result, especially if we see a Republican sweep emerge next week.
Is it clear that the Canadian economy is weaker than the U.S. economy right now?
Oh, yes. Yeah. If you look at this morning's GDP print in the U.S., it was spectacularly strong. Firstly, you're looking at a 2.8% annualized expansion in GDP, which is a very, very steady state considering like the post-pandemic period. It's well above trend from before the pandemic. If you look at final private sales to domestic purchasers, which is clearly a wonkish term, but it's a way to describe really what's happening under the hood once you take out like inventories and exports in the U.S. economy. It was running at 3.2%, which is just phenomenal. Private consumption or household consumption is at 3.7%. That's way above anything comparable here in Canada. Why? Because Canadians went into this pandemic and are still in the situation of carrying far more household debt, right? So as borrowing costs have risen on a global basis, Canadian households have suffered the consequences far more than their American counterparts. And so they're pulling back on spending. That is driving, economic underperformance in terms of what, sort of flows through the economy, but also on the investment side. Businesses in Canada are much more reluctant to invest right now against this backdrop relative to businesses in the U.S., which are, sort of participating in that sort of rising tide lifts all boats kind of phenomena.
That sounds like a repeat of this disappointing trend we've had in Canada in recent years, low business investment.
That's right. Unfortunately, this means that productivity gains in Canada have been more limited than they might have been otherwise. We don't know what could potentially catalyze a shift, especially given that right now the only sort of green shoots emerging in the Canadian economy are on the consumption side, because consumers, households are anticipating further decreases in interest rates in the years ahead. And as they anticipate those, sort of declines coming from the Bank of Canada, it does look like the housing market is finding its feet and starting to, show signs of more activity. And unfortunately, housing market activity does not boost productivity in Canada. It doesn't build a more sustainable foundation for the economy in the long run. So it really looks as if we're about to go through another phase like we've gone through repeatedly over the last couple of decades, in which the housing market pulls us out of the downturn, but the economy itself, becomes ever more vulnerable in the long run.
Because you can't really base an economy on housing, building houses in the long term.
That's it. The reality is we need other things to be driving growth. We need technological innovation. We need workers themselves to be producing more. We need those things to keep that economic growth well-rounded. And I think that's the crazy thing in Canada is that we still, although we're complaining a lot about tariffs against the U.S. or from the U.S. right now, one of the biggest issues impacting productivity in Canada is the lack of free trade between the provinces themselves, right? So, we're not fixing the problems at home, and that means that currency traders are looking at Canada from a much more skeptical perspective.
I read that Jason Kenney, when he was Premier of Alberta, tried unilaterally to bring down trade barriers.
Yes, and quite successfully so. And what's sort of fascinating about this is that if you look at the research in academic consensus, the crazy thing is that if you unilaterally reduce trade barriers, you actually support your economy itself. You don't need everyone else to do the same thing. You don't actually need reciprocal agreements, which defies sort of intuition, right? The average person would assume that if you lower tariffs, you need everyone else to do the same thing. That's not the case. And so this is part of what's helped that Albertan economy outperform other provinces in Canada in recent years, is that it is a much more free trade environment.
What about Doug Ford, the Premier of Ontario, getting mad that the liquor stores would buy paper bags in Quebec? That doesn't speak much to a commitment to free trade.
No, it doesn't. That does not, speak to really a lot of economic literacy at the end of the day, right? What we do need is goods to be imported from where they need to be imported from to, seize on cost differentials. What we need Ontario to focus on is what it can do best, right? And there are those sort of high knowledge aspects of the economy that are concentrated in Ontario and that, do need that support.
Thanks very much, Karl.